109 and $1,000 XRP. They actually said it out loud. Not on an anonymous crypto Twitter account, not in a late-night Discord server, at the New York Stock Exchange, on camera, with a full name attached. Dom Kwok, former Goldman Sachs investment banking analyst, co-founder of EZA, said it explicitly in a recorded interview. I think XRP is heading to $1,000 by 2030. And then his former employer, Goldman Sachs itself, turned around and disclosed the largest institutional XRP ETF position in the market, $153 million across 4 XRP funds. The man who made the call is watching the institution he used to work for validate it in real time. And Kwok's response on X was 3 words. No such thing as a coincidence. Now, before I go any further, let me tell you what this video is and what it is not. This is not me telling you XRP is going to $1,000. This is me walking you through the exact thesis behind that number, the math that supports it, the math that challenges it, and the honest institutional range that credible analysts are actually working with. Because the $1,000 conversation is no longer a meme. It has a coherent internal logic that the people dismissing it are not engaging with honestly. And you deserve to understand what that logic actually is so you can make your own decision. This is not financial advice. I am sharing publicly available information for educational purposes only. Always do your own research. Before we dive in, I want to run a poll in the comments. Type A if you think $1,000 XRP is possible by 2030. Type B if you think it's possible, but not by 2030. Type C if you think it's not possible at all. I want to see where this community sits before the breakdown, and then I want you to come back at the end and tell me if your answer changed. Welcome back. I am the Calm Analyst. Around here, we run the math that most channels skip. We present the bull case and the bear case with equal rigor, and we let the data decide. Today, we're going deep on the $1,000 XRP thesis, the velocity model, the liquidity math, the institutional mandate rotation, the honest market cap challenge, and the credible analyst range for what happens between now and 2030. Let's get into it. Let me set the scene. Today is April 1st, 2026. XRP is trading at 134s. The fear and greed index is at 8. Extreme fear. The lowest reading since the depths of the 2022 bear market. Ripple just unlocked 1 billion XRP from escrow this morning. A routine monthly release, 60 to 80% of which historically gets relocked rather than sold into the market. Brad Garlinghouse just said in a Fox Business interview that Ripple's Treasury division processes $13 trillion in annual fiat payments for corporate clients, and 0% of it has migrated to crypto rails yet. 0. He called it the biggest untapped opportunity in finance. And April has historically been XRP's strongest month of the year. Over the last 11 years, XRP has posted an average April return of 24.8%. Not guaranteed, not a certainty. But historically, April is where XRP recovers from what March did to it, and March was brutal. Now let me walk you through the actual $1,000 thesis step by step. Because Kwok has explained this publicly multiple times, and the logic deserves to be presented properly before you decide whether to accept it, challenge it, or dismiss it. The first pillar is the size of the global payments market. SWIFT handles approximately $150 trillion in cross-border payment volume every year. The Bank of England projected that number could reach $250 trillion by 2030 as global trade and remittance volumes expand. That is the total addressable market that XRP's on-demand liquidity infrastructure was designed to serve. Banks globally hold an estimated $1.8 trillion in pre-funded Nostro accounts just to facilitate cross-border settlement. Capital that earns essentially nothing while it sits idle waiting to be called upon. XRP eliminates that requirement entirely. In the on-demand liquidity model, a bank converts its source currency to XRP. The XRP traverses the ledger in 3 to 5 seconds. It's immediately converted to the destination currency on the other side. No pre-funding, no idle capital, fractions of a cent per transaction. Quack's argument is that even capturing a small slice of that $150 to $250 trillion annual market creates demand for XRP tokens at a scale the current price does not reflect. And Garlinghouse just confirmed that $13 trillion in payment volume is sitting inside Ripple's own treasury platform, waiting for the legal framework to tip toward crypto rails. That is not a bear signal. That is the largest unpriced catalyst in the XRP ecosystem right now. The second pillar is the institutional mandate rotation. And this is the part that Quack's Goldman Sachs background gives him unique credibility to speak on. Investment mandates at pension funds, sovereign wealth funds, and asset managers operate under fiduciary duty requirements that dictate what assets they are legally permitted to hold. For 4 years, from the December 2020 SEC lawsuit through March 2026, XRP existed in a gray zone that most fiduciary frameworks could not accommodate. The March 17th commodity classification changed that. It put XRP in the same federal regulatory category as gold, oil, and Bitcoin, assets that institutional mandates routinely allow. And when mandate rules change, the buying is not discretionary. It is systematic. The rules say buy, and the capital flows. A Coinbase and EY survey of 351 institutional investors, 96% managing over $1 billion each, found that 25% plan to add XRP in 2026. And 65% said regulatory clarity is the single biggest factor holding them back. That clarity now exists at the regulatory level. The Clarity Act codifies it into permanent law, and the Senate Banking Committee markup is targeting the second half of April. If you're following the logic of the thesis so far, smash that like button. Not because you agree with the $1,000 target, because you deserve to have the actual argument presented honestly instead of dismissed with a meme. One tap helps this analysis reach the next person who needs to hear the real math. Now let me get into the third pillar, and this is the one that makes or breaks the $1,000 conversation: the velocity model. This is the part of the thesis that most critics fail to address, because it requires understanding how bridge currency economics work, which is fundamentally different from how store of value economics work. XRP is not designed to be held. It is designed to move. In the on-demand liquidity model, XRP is in transit for seconds. It is bought, transmitted, and sold in a single atomic transaction. This means the price impact of XRP's settlement roll is not determined by how many people want to hold it at any given moment. It is determined by the velocity of value passing through it per unit of time. Mason Versluis modeled this explicitly. His liquidity framework showed that if the XRP ledger needs to process $1 trillion in daily cross-border volume, which represents less than 1% of the global annual total, the minimum price per XRP required for the system to maintain sufficient liquidity without running dry is approximately $1,000, not as a speculative ceiling, as a functional floor for the system to operate. At current prices of $134, the XRP ledger can sustainably support roughly $1.3 billion of daily transaction throughput before supply constraints create pricing friction. $1 trillion of daily volume requires a price approximately 750 times higher to maintain system liquidity. That is basic liquidity economics applied to a bridge currency. The velocity model produces a fundamentally different answer than the traditional static market cap model. And the question of which model applies to XRP is the actual substance of the $1,000 debate. A debate that most people dismissing the thesis have not engaged with at the level of detail the argument deserves. Now, let me give you the honest counter-argument, because I owe you that. $1,000 XRP produces a market cap of approximately $61 trillion on the fully diluted supply. The entire United States stock market is worth roughly $48 to $52 trillion. $1,000 XRP would be the largest financial asset in human history by a wide margin. The critics who raise that number are not wrong to raise it. It is the correct starting point for the debate. Where they go wrong is assuming that the traditional market cap framework is the right model for a bridge currency designed to be in transit for 3 to 5 seconds. Where the velocity model proponents go wrong is assuming that the global payments market will route through XRP at the scale required to make the liquidity math work within a near-term time frame. The honest answer sits between those two positions. $1,000 XRP is a theoretical possibility on a 10 to 20-year horizon if the velocity thesis plays out at scale. It is not a 2026 event. It is not a 2027 event. It is a 2030 to 2040 conversation that depends on XRP capturing a meaningful percentage of global cross-border volume. And here's where this week's developments make that conversation more serious than it's ever been. SWIFT's new framework just wired XRP into the routing infrastructure of 11,000 banks across 200 countries. Not through Ripple's sales team, through SWIFT. The plumbing that handles the $150 trillion in annual cross-border volume now has an optional XRP settlement path built in. That doesn't guarantee adoption, but it removes the distribution bottleneck that was the single biggest obstacle between where Ripple is today and where the velocity math starts to apply. Comment below. Now that you understand the velocity model, the idea that $1,000 is not a speculation target, but a liquidity requirement at a certain volume threshold. Does that change how you think about the number? Type velocity if it reframed the conversation for you. Type still skeptical if the market cap challenge is still your primary objection. I want to see the honest split. Now, let me give you the credible institutional analyst range. Because this is what you actually need to plan around for the next 1 to 4 years. Standard Chartered Bank has a $28 target for 2030. Their global head of digital assets research, Jeffrey Kendrick, maintained that target through the entire 2026 correction without adjusting it. They also have a stepped roadmap, $7 for 2027, $12.60 for 2028, $19.60 for 2029, and $28 for 2030. A graduated repricing with identified catalysts at each level. Nick Ruck at LVRG Research sees $10 as achievable by 2030 if ETF inflows scale past $5 billion and Bitcoin recovers toward new highs. The broad consensus from 5 credible institutional-grade analysts clusters between $5 and $15 for 2030, representing 250 to 935% upside from today's 134 and the honest bear in the room. Adam Spatacco at NASDAQ sees XRP potentially falling back to 50 cents to $1 by 2030. His argument is that banks can use Ripple's infrastructure and settle in fiat or RLUSD, without ever requiring the XRP token. And that risk is real. The $13 trillion flowing through Ripple Treasury right now is flowing in fiat, not XRP. Deutsche Bank and Societe Generale started using Ripple's infrastructure in early 2026 and settled in RLUSD and fiat, not XRP. The gap between Ripple winning and XRP winning is the most important honest risk in this entire thesis. And the bridge that closes that gap is the Clarity Act. Because the legal framework that allows U.S. banks to run ODL corridors directly with XRP, instead of defaulting to stablecoins because the legal risk of using a volatile token for fiduciary settlement is too high, is the Clarity Act. Without it, banks settle in RLUSD and fiat. With it, XRP becomes a legally cleared option for on-demand liquidity. Garlinghouse is pushing for passage by the end of April. The Senate is back from recess on April 13th. The Banking Committee markup has not been formally scheduled yet, but every indicator points to the second half of April as the window that determines XRP's trajectory for the rest of 2026. Subscribe right now. Hit the bell, drop it in the comments. Because the Clarity Act vote, the Goldman Sachs Q1 filing, and the Swift June framework launch are all landing in the same window, and each one determines which scenario plays out: the Standard Chartered $28 roadmap or the Spataco bear case. Now let me give you the full context for why the accumulation happening right now matters, because this is the part that connects the long-term thesis to today's price. Fear and greed at 8. XRP down 60% from where Kwok made his $1,000 call. RSI at levels not seen since the 2022 bear market. ETF inflows that were pulling in $200 million per week at launch dropped to $636,000 in a single week in early March. And in that exact environment, Goldman Sachs is holding $153 million in XRP ETFs. 7-spot ETFs are live with $1.44 billion in cumulative inflows. Binance open interest jumped 15% in a single reporting window. 156 identical buy orders fired across Coinbase at 18.5-second intervals. 35 million XRP absorbed in under an hour. Franklin Templeton's head of digital assets says, "Do not underestimate Ripple." CME has XRP in its 10K as an institutional diversification tool. The U.S. Department of Labor proposed easing 401k rules this week in a way that could open the $8.8 trillion U.S. retirement market to crypto exposure. If even a fraction of that eventually reaches XRP through regulated products, the capital flows dwarf everything the ETF ecosystem has attracted so far. And Ripple Prime just expanded into on-chain perpetual markets for gold, silver, and oil through hyperliquid integration. That is institutional infrastructure for commodity settlement on blockchain, a signal that Ripple is building rails for traditional financial assets to move on-chain at scale. Nobody rang a bell at 17 cents in 2020. Nobody rang a bell at 30 cents in 2023. They will not ring one now. The people who will be at every price level between here and wherever XRP goes are accumulating right now at 134. With fear and greed at 8, while retail is frozen and the institutions are loading. Let me bring it all together. $1,000 XRP is a 2030 to 2040 conversation. If the velocity thesis plays out at the scale the global payments market implies, it is not a fantasy. It is a liquidity math requirement. But it requires XRP capturing a level of cross-border volume that is 750 times higher than current throughput. $5 to $28 is the credible institutional range for what happens between now and 2030 if the regulatory catalysts land. Standard Chartered's stepped roadmap from $7 to $28 is the most detailed institutional projection available. The honest bear risk is real. Banks can settle in RLUSD and fiat without XRP. That risk closes when the Clarity Act passes and ODL corridors become legally cleared for U.S. institutions. And 134 in April 2026, with fear and greed at 8, with Goldman Sachs holding $153 million, with the commodity classification live, with the Clarity Act vote weeks away, with $13 trillion in Ripple's corporate payment pipeline waiting for the legal framework to tip, with Swift wiring XRP into 11,000 banks, with April historically delivering 24.8% average returns. That is the setup. The setup before the move is always more valuable than the confirmation after it. Price is a distraction. Value is the reality. Structure is what matters. And the structure being built around XRP right now, from Goldman Sachs to Swift to the U.S. Congress to the DTCC to Franklin Templeton to the velocity math itself, is the most comprehensive case for any single digital asset in the history of this market. In a market fueled by emotion and noise, we thrive on data and composure. Remember, haste leads to loss, while calm analysis leads to victory. If you made it to the end, go back to your comment. Did your answer change? Is it still A, B, or C? Tell me what shifted. Tell me what didn't. The honest debate is what makes this community stronger than every echo chamber in the crypto space. Comment Calm Analyst below. Let me see who stayed for the complete thesis. The bull case, the bear case, the velocity model, the market cap challenge, and the institutional range. And share this with one person who has dismissed $1,000 XRP without understanding the velocity argument, not to convince them, to make sure they've engaged with the actual math before they make their decision. Like, subscribe, notifications on. I'll see you in the next one. Stay patient, stay rational. And as we always do, we don't wait for the future. We plan for it. Peace.